Hugh, Goldman Sachs just put out their 2013 economic outlook, and we are expecting another year of economic contraction in Europe. Why has economic growth in Europe been so weak, and why do we think it will remain so?
Well, I think our main view is that Europe entered the financial crisis in the last few years with a number of inherited problems. On the public sector side, too much government debt and weak fiscal balance sheets in general. On the private sector side, too much borrowing and excessive leverage on the private sector balance sheet. And there's a necessary adjustment to be made to those imbalances. So what we have seen over the past few years, and we expect to continue to see in 2013, is a process on the public sector side of fiscal consolidation and on the private sector side of deleveraging, both of which will weigh on spending in the economy, suppress aggregate demand, and ensure that growth is low. And unfortunately, growth from the rest of the world, external demand to the euro area, even though recovering in 2013, won't be growing strong enough to replace the weakness coming from these domestic sources.
But we've actually been revising down our European economic growth forecasts and now expect much weaker growth in 2013. In fact, contractionary growth for 2013, which is much weaker than we expected a year ago. What's really been driving those downward revisions?
Well, a year ago, we took the view that the deterioration in the euro area at a time when the crisis was reaching its peak and there was a real threat to the financial system in Europe coming from the fragmentation and dysfunctionality of financial markets, would create a sufficient economic and financial crisis that you would see enough political and economic pressure to make very deep, fundamental, institutional and structural changes to the European economy. On the one hand, the good news is that we avoided that cathartic crisis, in large part because the ECB stepped in at the beginning of this year with its three-year longer-term refinancing operations, and in mid-year with the new outright monetary transactions program identified by Mr. Draghi in London just before the Olympics. And those two measures were sufficient to dampen down this immediate financial crisis pressure. But the sort of side effect of these actions was that they relieved the pressure on the political process to undertake these necessary adjustments, reforms, and institutional changes. And as a result, the moment where we can really talk about turning the page and moving forward from the crisis has been pushed back from the end of 2012, beginning of 2013, as we envisaged last year, well into 2014 and beyond. And while the residual uncertainty in the economy persists in the absence of that turning of the page, we think that uncertainty will weigh on consumption, will weigh on investment spending, and keep demand in the euro area weak.
So is it all gloom and doom for 2013, or is there anything to be more positive about?
Well, I think there is a silver lining to the dark cloud of weak growth in the euro area. The causes of that weak growth, as I said, are the need for adjustment. But the positive side of this is that adjustment is taking place. So at a 2 to 3 year horizon, we do have the prospect of a euro area which has got stronger balance sheets on both the public and private sector side, has regained some competitiveness, especially in the peripheral economies that have proved most vulnerable, and is better placed to grow forward from there in a more sustainable way. Of course, waiting 2 or 3 years is a long time to wait, and we've seen in the past that in the process of waiting, many dislocations and problems can occur. So I think the other good news is that the more proactive actions of the ECB and the fact that those actions have now achieved increasing credibility in the eyes of financial market participants do make it less likely that we're going to see the type of acute crises, acute dysfunctionality in financial markets that's proved a cause of great problems for financial market investors, but has also proved a great problem for participants in the real economy in terms of weighing on growth and investment and consumption decisions.